In this video, I want to talk about the truth about emerging market investing. I want to highlight the risk as well as the reward. Emerging market investing is very interesting. Actually, you stand to have the benefits of an outsized returns, but all the same, we should not forget the fact that it is inherently risky. And so let's examine the opportunities you could come across in investing in emerging markets, a market like ours, a market like Nigeria. We look at the opportunities. Number one is high growth potential. There is that high growth potential. So emerging markets typically experience faster economic growth than what is obtainable in developed economies. These are driven by factors such as industrialization, urbanization, as well as a growing middle class. The middle class, is kind of growing, and this growth presents attractive investment opportunities, in sectors such as infrastructure, consumer goods, as well as technology. In short, most other sectors stand to benefit from the growth in the middle class. Number two is market diversification. Market diversification. Investing in emerging markets can offer diversification benefits. Reducing the reliance on developed markets. You don't need to rely so much if you are based in the developed markets like in the US or the UK. You don't need to rely so much on your domestic economy. You could invest abroad. You could invest in emerging markets and enjoy the opportunities, therein. And if you're in Nigeria, you just, you could invest in the country here and enjoy this particular, opportunity. Although you could diversify, outside the country, you could, consider geographic diversification. But all the same, you stand to benefit from, what is obtainable in the typical emerging markets. And so these economies, often have different business cycles and market conditions, helping to smooth overall portfolio risk. Let's say you are based abroad, you are a Nigerian based abroad in the diaspora. You may choose to invest in the country. It's a very important advice counsel I will give you. And by so doing, you are kind of diversifying your investments. Number three is attractive valuations. Attractive valuations. So many stocks in emerging markets are undervalued compared to those in the developed markets. Because of the inherent inefficiency in the market, stocks in emerging economies tend to be undervalued. In other words, they are underpriced. They are cheap compared to their intrinsic values. Investors can find opportunities to purchase stocks at lower prices, with high growth potentials, creating the possibility of a high capital appreciation, of a significant capital appreciation. And so generally, you make profit when you buy, not necessarily when you sell. But when you buy stocks at a cheap enough price, then definitely you would come up with cash out at a decent profits, at the end of the day. So number four is resource-rich economies. Resource-rich economies. So many emerging markets are rich in natural resources like oil, like minerals, and agricultural products. So investing in these markets can provide exposure to sectors that benefit from global demands for commodities, sectors that benefit from demands for resources and commodities. If you invest in those sectors, you are bound to do very well. Like, let's say in the Nigerian stock market, we invest in the agricultural sectors. I don't like recommending individual stocks. It is not my I'm not very comfortable about it. But generally, stocks in the agricultural sectors, you know, let's say a company specializes in in palm oil production. These products are exported abroad, and they earn foreign currencies. You see, so the sector tends to do very, very well. The agricultural sector of the Nigerian Stock Exchange. Number 5 is demographic advantages. Demographic advantages. So emerging markets often have younger population with rising disposable income, which drive demands for goods and services, as well as the needs for education and infrastructure. This creates long-term growth prospects in sectors such as consumer goods, sectors like real estate, as well as healthcare. They tend to benefit from investing in emerging markets. So if you consider the opportunities, actually, we wouldn't forget the challenges of investing in emerging markets. So let's look at the challenges. Number 1 is market volatility. Market volatility. So emerging market tends to be more volatile than developed markets, often due to political instability, economic policy changes, and external factors like commodity price fluctuations. So this volatility can create substantial risks for investors because it depends so much on exports. In a case where there's currency fluctuation, it could lead to volatility. In a case where there's political instability in a country, that could lead to volatility as well, compared to what's obtainable in most stable economies. Number 2 is political and economic instability. Political and economic instability. Emerging markets may experience high level of political risk, including government changes, corruption, and economic mismanagement. This risk can disrupt markets and negatively affect investor return. Like what was obtainable like what took place in some West African countries, some francophone West African countries. You discovered that there was this military coup here and there. That's a typical form of political instability, and they were so much against their colonial and the country that colonized them. They were so much against France, you see, and it wasn't really a good development at all. Such kind of occurrence can drive away foreign investors. It's a typical challenge you face, when you invest in an emerging economy or in an emerging market. Number 3 is currency risk. Currency risk. You see? And so investing in emerging market exposes investors to currency fluctuations, as the value of local currency can be volatile relative to the US dollar or other major currencies. Like in my own case, Nigeria, there's an hour devaluation of the naira. That's why what used to be a naira a naira to around 300 and something naira. Now it's a naira to about $1,600. You see, so this level of currency risk will not only affect individual investors, but affects even corporation as well. Corporations like MTN, like Nestle, multinationals in the Nigerian stock market actually had these problems, and it really affected their profitability to a larger extent. Currency risk. They borrowed money in dollars when when the exchange rate was favorable. Let's say they borrowed at maybe 350 or 600, and now they have to repay back at 1,600. Imagine the kind of differences. And so it's a typical risk one must consider, either as an institutional, either as a retail investor, an individual investor, or as an institutional investor. We must take into consideration this form of risk. Number 4 is underdeveloped infrastructure and financial systems, underdeveloped infrastructure and financial systems. So many emerging markets have less mature, less developed, and less refined financial systems. And the regulatory framework is not as solid as what is obtainable in advanced countries, which can create challenges for investors. And so poor infrastructure, limited access to credit, and less transparent financial reporting can increase risk. In the case where the reporting standard is below what is obtained internationally, it might create risks for foreign investors. Not only that, there's limited access to credit. Our banks may not be able to fund high level, or uh, may not be able to have may not have the capital to fund expensive projects. That's why companies in Nigeria, particularly multinationals and banks, they tend to source for money outside the country. They source for money abroad because of limited access to sufficient credit to run their operation. And in a case where there's currency problem discovered that time, they will run into huge losses, like what happened to a company like MTN and to other related countries like Nestle and the rest. They had this foreign currency fluctuation, and it affected their investment negatively. They sustained, foreign currency losses. Number 5 is lack of liquidity. Lack of liquidity. So emerging markets tend to have less liquidity, compared to developed markets, and this can make it difficult to buy or sell large quantity of stocks without affecting the price. In the case where there is no sufficient liquidity, if you sell stocks in large quantity, it will affect the stock price. And if you buy in large quantity, it will equally affect the stock price because of the level of liquidity in the market or in that particular stocks. And this can be a concern for investors looking for flexibility as well as on short-term gains. You want to exit the markets, then of course it will present a problem to you. So these are the opportunities as well as the challenges, one could face, for investing in an emerging market. But all the same, emerging market investment is quite attractive. If you can tackle these challenges adequately, then of course you are good to go when it comes to investing in emerging market. For us who are in a country like Nigeria, we have no other option but to invest in our country and to enjoy the opportunities inherent therein.